Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is a brand new webcast series. It's called Investing in Dividend Stocks. I'm really looking forward to this one because we are going to be taking a step back from those more active strategies and planning for the longer term, looking at things through the lens of that trader who's maybe, or that investor who's looking at a longer term horizon, possibly with an emphasis on income. We're going to be talking about what dividend stocks are, where they might be located, how they might be invested in, when we might choose to enter or exit those. A lot to cover. Really looking forward to this series, always with the long term in mind. But before we get to any of that, though, let me first of all say hello to everybody out there who's chatting out there in our live YouTube audience. Great to see you all. Hello there, Will and Richard, Mighty Mouse, Cecil, Greg, Austin, Sharon, Ricebird, Rojo, Simone, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. It's always a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Thursday webcast series, and we're going to be kicking things off promptly at noon Eastern time each Thursday. Love to have you here. Now, I also want to let our live stream audience members know that my very good friend Brent Moores is going to be hanging out in the chats. He's going to be watching for any questions that come in that I don't get a chance to address. Brent's just going to be there to pick up my slack. Thanks for having my back there, Brent. Now, also, Brent and I would like to issue an invitation to everybody watching, everybody listening, to follow your favorite Schwab presenters on social media. You can follow Brent and me on X. So you can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. And you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. It'll take you right to my profile. You can give me a follow there. But let's get into this discussion. Of course, as we do, dividend investing certainly carries risks. So we need to be aware of that. Let me see, there was a question that just came in. Paul, I'm not going to be probably getting into that question today, but I am going to be getting into dividend investing overall. In any case, this material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Investing involves risks, including the loss of principal. Risks of the REITs are similar to those associated with direct ownership of real estate, and any investment decision you make in your self-directed account is solely your responsibility. All right. So with that said, let's set an agenda for today's discussion. It's largely going to be the format for future discussions. We're going to be covering dividend stock basics, what an investor might be looking for in a potential dividend stock candidate, when they might choose to get in, when they might choose to get out. We're going to include a market review very quickly, just to get a little bit of context regarding the sort of conditions that a dividend investor might be dealing with at the moment of these discussions. And of course, we're going to be building an example portfolio, placing stock trades, might even replace that with the word investments in Thinkorswim paper money. We're not actually going to be making lots of changes to our positions once they've been established, although they might be made under specific conditions, and I'll talk about those conditions. So that's what we're going to be covering today. That's what we're going to be covering each week. I hope that you'll put it in your calendar to join us each week. We're basically going to be conceptually managing an example paper money portfolio of about $200,000, distributing that across a range of dividend investments, and managing those occasionally as we see fit. So let's get right into this discussion. And then, you know what? I'm going to kind of skip to this middle point. No, let's do one thing first, okay? Just to sort of set the stage for why some investors are attracted to dividend-paying companies. Of course, we want to set that against the potential drawbacks of dividend investments. So let's talk about some pros and some cons just very quickly. So first of all, some dividend basics, starting with the fun stuff. Stocks generally offer a greater possibility of capital appreciation than other assets. So when we own a dividend stock, we don't have just the access to the current or potential future dividends, but also that stock can go up in price. And if it goes up rapidly, that can keep us ahead of things like inflation. It can help to potentially grow a portfolio. Dividend-paying companies actually tend to be less volatile than pure growth stocks, according to a number of studies that have been conducted. A portfolio consisting of dividend stocks tend to just have lower day-to-day, week-to-week, month-to-month, year-to-year volatility. It's not a guarantee of every portfolio under every market circumstance, but that's one of the things that attracts some investors, is sort of a smoother ride. Dividend rates may change, but they're generally paid throughout market ups and downs. And interestingly, looking for stocks during those down periods or during those down cycles might actually deliver the potential for greater yields on dividends. It's going to be a point of emphasis in our webcast series. And dividend stocks may add diversification to growth or income portfolios. Now, obviously, may is a qualified statement. Diversification doesn't mean that we're eliminating risk, but increased diversification, the dividends adding a smoothing element to market ups and downs, the potential for growth, lots of reasons that a trader might be, or an investor might be attracted to dividends as an investment consideration. Now, also, there have certainly been studies that seem to reveal that dividend stocks actually, when considering price appreciation plus the dividends paid, over time have historically a stronger performance than growth stocks. That's not always true, again, in every market condition, but we may, some dividend investors have experienced lower portfolio volatility, but also potentially increased portfolio performance overall. So if we have that thought in the back of our mind that dividend stocks they're boring stocks, maybe just for older investors who are extremely conservative, that may not always be the case. Now, what are some risks? Well, capital appreciation of dividend stocks is not guaranteed. The price might go up, but price can also go down. Dividend payments can actually decline or be discontinued. That's something that we're going to monitor as we manage our portfolio. And if we see that happening, or even indications that it may be approaching, we can't always anticipate that, that may result in the elimination or reduction of a position within our example portfolio. Dividends can be impacted by rising inflation. Absolutely. If dividends are trailing behind rates of inflation, there may not be as large of a potential investor segment interested in investing in dividends. And dividend stocks may, but don't necessarily add diversification to growth or income portfolio. And even diversification is not a guarantee of a hedge against risk. All right. So there are pros and cons to dividend investing, but we're going to be taking that position of the investor who's decided to invest in dividend stocks. We talk about what their priorities might be, how they might find stocks that meet those priorities, when they might choose to enter, and even when they might choose to exit or reduce exposure to some positions. All right. Now, before I go into any of that, before we get into the priorities of the dividend investor, I do want to get a little bit of context regarding today's dividend market environment. Now, in a lot of our webcast series, of course, you'll see us flash over and we'll take a look at the major market indices, for example, maybe the S&P 500. Now, this webcast series is not about trading, though. So for a dividend investor, it might still be interesting to see what stocks in general have been doing. And these are the S&P 500 component companies being represented by the S&P 500 index, many of which actually do pay dividends. So it's nice to see, yeah, we've had a nice go since April, and really even over a much longer term. Stocks have been doing well, but there are some other things that a would-be dividend investor or an active dividend investor might want to bear in mind. And that is, let's say, the quote-unquote, the competition. Not just how, what should we call them, the good guys, or how our team is doing, but what does it look like on the other side with the competition? That's the way I'm gonna label it. What is a dividend investor in conceptual competition with. Here we are, if we're investing in dividend stocks, what we'd like to see is that everybody else has an interest in investing in dividend stocks as well, maybe driving up their prices over the long term, contributing to the performance of the portfolio, in addition to the yields that are being paid by the company. But other investors have the choice to direct their funds elsewhere. What's some of the competition? Yeah, we could actually maybe look at maybe a fixed income. So for example, let's see what's going on. Yeah, JR says bonds. Yep. Let's see what's going on with yields, because there is historically a pretty good relationship between the performance of dividend paying stocks. It's not a direct correlation, but a relationship there between the performance of those stocks and alternative investments, including bonds. So let's flash over here to the index of 10-year yields. So that symbol on Thinkorswim is TNX:CGI. So what's been going on with yields? I don't think anybody's going to be surprised by this, as the Fed has been cutting rates. That has an impact on yields as a sort of a ripple effect. Those yields have been coming down, and as government-backed options or alternatives are looking less and less attractive potentially to income investors or to just investors seeking, let's say, diversification, where might their attention turn? Well, with many dividend stocks, we're going to see a strong inverse correlation between the behavior of these longer-term yields and the behavior of those stocks. And you're going to see that on a couple of charts that we see in just a moment. Just remember, here's what's been going on with yields on Treasury security, 10-year yields. That's over the last year. What if we were to expand this out over the longer term? Well, there was a great expansionary phase where yields were rising and rising and rising, but you can see this period where we've consolidating and have actually been pulling back from those recent highs. So that's interesting. That may provide a bit of a tailwind for the dividend investor. So let's say that we've decided, all right, well, let's go find some dividend stocks. Let's start to build an example portfolio. Well, what are the priorities of a dividend investor? I can't speak for every dividend investor out there, but I'm going to list out, let's make a list of some example priorities. All right. Before we go looking for stocks, we might want to define what it is exactly we're looking for. So number one, of course, we're looking for dividends. What is the yield? Now, there's a difference between a dividend and that dividend's yield. If a $1 dividend is being paid on $100 stock, that's a 1% yield. Let's say it's $1 over the course of a year total. Maybe it's 25 cents per quarter. On the other hand, if that's being paid on a $50 stock, that's a 2% yield. If that's on a $33 stock, that's a 3% yield. So the yield is the percentage return on the current value of the stock in relation to the size of the dividend being paid. All right, so long snappers say it might be hinting that they have a preference, saying 5% or higher. Now, some traders do have, or some traders, forgive me, investors, right? If you don't understand the distinction, typically trading is done for the shorter term. Investing is done for the longer term. There we go. So yes, some investors may have their own priorities or the specific priorities. Not only are they emphasizing yield, but maybe a specific minimum yield. Now, for this webcast, it may just be, let's say that we're looking through the lens of the trader or the investor who is just maybe saying, generally speaking, higher yield is preferred, all other things being held constant, right? But yield, that's one thing that we're going to be looking for today. Also, the trader or the investor may be looking for diversification. All right, diversification meaning if we buy a bunch of dividend-paying stocks, but they're all in the same sector, for example, that can carry a lot of risk. If that sector falls out of favor, that can actually, the decline of that sector can rapidly offset the income from the yields or the dividends being collected, and maybe the trader is, or the investor is attempting to minimize that exposure. All right, number 3. This is maybe something you might not have considered, but the payment schedule. For some investors looking for income, and whether they intend to spend that income or just reinvest that income, maybe a point of emphasis is the consistency of the income from one month to the next. It's not always the case. For some investors, they might be totally fine if they get $1,000 in January and $3,000 in February and $500 in March. But if we're looking for consistency, either for the purposes of spending that income or for the more consistent reinvestment to try to accomplish, let's say, a dollar cost averaging effect over the time, let's say that for this webcast series, we're going to emphasize the payment schedule, trying to find complementary payment cycles, right? Now, this is an example. This is a concept known as laddering. Now, let me tell you what laddering is. Let's go back over here to our slide deck. So let's talk about a dividend ladder for potentially more consistent dividends. So some investors may consider investing in stocks that have sequential payments. In other words, many stocks pay on a quarterly basis. We might be looking for those quarterly cycles to be complementary. For example, maybe they buy symbol NOP, which pays a 50-cent dividend, and those dividend distributions are in January, April, July, and October. Maybe they invest in LMN, which in its dividend as in February, May, August, and November. Notice we're filling in the monthly gaps. ZYX paying its dividend in March, June, September, and December, so that we're getting some consistency over time. And I'm going to be doing that in this webcast series. That's going to be a point of emphasis. It's not for everyone, right? So back to our priorities now. Potential priority number 4 is the consistency of those dividends. Some companies do a pretty good job of declaring a dividend. They maintain it for a period of time, and then they reduce it or they cut it according to their corporate needs. For other companies, a real point of emphasis is to be consistent with the distribution and the increasing of those dividend payments. And that's going to be a point of emphasis in our example portfolio for this webcast series. We're going to be looking for companies that have been very consistent in the payment of their dividends, and in many cases, looking for companies, let's say that our investor is looking for companies that have a good track record of increasing those dividend payments over time. All right. Eric, I might do that in a future webcast. Thanks for the question. Paul, you're getting ahead of me there. Paul, that's a good point. I'm not going to say what Paul said, but yeah, we're definitely going to be doing that today. We're going to be talking about that today. Anyway, so that's a bit of a teaser. What is a potential threat to dividend consistency? Let's say a company has declared a dividend, they've been paying the dividend, and then all of a sudden there is a looming threat to that dividend. If companies take on increasing loads of debt, that can be a threat to ongoing dividends. Because if a publicly traded organization is forced into a corner where they have to decide between, well, we have so much cash in reserve, so much access to additional debt, we've got to pay our current debtors, or maybe we can send Cameron his dividend check, which is optional. Where do you think they're going to give the emphasis there? Yeah, they're going to pay their creditors. And if they have to do that at the cost of reducing the dividend, they might do that. So debt is going to be a priority for dividend investors in many cases. All right. Another potential priority is the volatility of the stock. Again, some traders or some investors are completely okay with owning a stock that's going up and going down, as long as the dividend is being paid regularly, maybe with the hope that over time, going up and going down in the short term will result in longer term appreciation in price, in addition to the the dividend that's being paid. But for others, they might prefer a smoother ride, less of a roller coaster effect. So we will discuss this, but you'll see me probably making the decision to buy some stocks where volatility levels are actually higher than average. All right, let's see. See if we're missing anything else here. Yeah, Brian, you know where this is headed to. Brian just said exactly the same thing that Paul did right after. All right, it's not that I'm headed in that direction, but it's going to be a consideration. All right, spoiler alert, we're going to be talking about dividend aristocrats today, which can serve to accomplish a lot of these objectives, not every single one. And there are definitely stocks outside of the list of companies known as the dividend aristocrats, because there are specific qualifiers that might eliminate, perfectly good dividend stocks from being on that list. So we'll talk about what the dividend aristocrats are, but we're going to be maybe buying one of those today. Anyway, a final priority here is the performance. And I'm going to call this the total performance of the stock purchased over time. Because just collecting a dividend, if the stock is depreciating over time, that's still net a losing game. So a trader or an investor might be looking for, and you'll have to forgive me again for traded versus an investor, because in my world, I say both terms all the time. Any case, we're going to be looking for stocks that have at least a long-term track record of a net delivery of gains for the investor, including price appreciation and dividends. We can actually show that right on a chart. Now, I said the final priority for our hypothetical dividend investor here was the total performance. I'm going to add one more action that our investor might take. And that is, in this webcast series, we are going to reinvest. So reinvestment, what does that mean? Well, it means we're not going to be taking the dividends and spending them. Instead, we're going to be reinvesting those back into the stock. Just conceptually, how might that be done? Let's address that right now. Well, that can be done if you go to your Schwab online account. Looks like it's logged me out. Bear with me for just a moment. I'm going to pull this over to a side screen so I can log back in comfortable privacy. Go. And once that's loaded up, let me bring that back into your view. All right, but if we're looking to reinvest the dividends from a stock, that can be done. You just go to the accounts right up, the accounts tab right up here, select positions, and then there's a column right here that says, hey, Cameron, you want to reinvest the dividends from this stock? There's going to be a yes or no toggle there. I don't have any stocks in this example Schwab account, but that's where it would be done. Yep. So 864 refers to this as a DRIP. Yeah, dividend reinvestment program is what that means. But yeah, we're just reinvesting the dividends. Conceptually, what does that do? Well, that might enhance the growth of the stock over time. And according to some studies, the combination of those two factors, price appreciation just in the changing levels of supply and demand for the stock, plus reinvestment of dividends, may give that investor a competitive advantage over just even growth investing over time. Again, it's not a guarantee of future performance. It has seemed to be a historical tendency in the past. So there we go. There are our example priorities for dividend investing. So how might we accomplish that? Well, a lot of this, as Brian and who else was it? Brian and Paul, yeah, hinted at something known as the dividend aristocrats. What in the world are the dividend aristocrats? Sounds really cool. I love the title, actually. That's a great name. If I were out there trying to sell dividend aristocrats, that's a title I might come up with. I'm not promoting or selling dividend aristocrats right now. But dividend aristocrats are basically just a group of stocks that all meet a very specifically defined set of criteria. And either they meet those criteria and they carry that title of aristocrat, or they don't meet the criteria and they don't carry that. But for some dividend investors, they look to the aristocrats for yield and for consistency. So specifically, a dividend aristocrat is an S&P 500 component company, at least $3 billion in market capitalization, which is really, yeah, they're going to be with almost no exception, but that has at least a 25-year track record of not just paying a dividend, not just maintaining a dividend, but increasing that dividend every year for at least the last 25 years. Now, Paul will talk about kings in a future webcast, but today we'll just go with the aristocrats. Now, out of the thousands of companies that trade on the public U.S. exchanges right now, there are what, about 60 that actually qualify as dividend aristocrats? And you might say, well, Cameron, ooh, that sounds cool. How can I find the dividend aristocrats? Well, you can Google it. I think that's a quick way to do it. You go to Google and you type in, or your favorite AI, whatever. But go to Google, type in dividend aristocrats list 2025. We just started 2026, so this will be changing over time, maybe a little bit. But we just type in those keywords and we can find a list of those companies that currently meet those criteria. And then what the investor can do is just type those into a watch list to keep an eye on those. So you may have noticed right here, Brian, you might have noticed that. Who else was it again? Paul, I think. Might have noticed, Cameron, you already have it queued up. You've kind of shown your hand here. Yeah. Here's a watch list of the companies that make up or that each qualify according to that specific list of criteria. And you can see how that may begin to address the investor's priorities. They each generate a yield. We don't know exactly how much. They have a demonstrated track record of consistency. And they tend to be kind of lower volatility because they are S&P 500 companies. Now, not every S&P 500 company is going to be lower volatility, but let's say that we're going to use those as sort of a launching point for this webcast series. We're going to be expanding on those in future discussions. So I have this watch list that I've created of those companies. I'm going to share this. Let's go down here and share the dividend aristocrats. So you don't have to go type these all in. Let's click share. I'm going to paste that in the chat window. And I'm going to make a note in my session notes off to my right side to include that link. Go. For those that are watching on the archive, you weren't here in the live stream, you don't get to go to the chats and retrieve that link. You can go down in the video description down below, and I'll post a link down there. All right, now, of course, shared links are not guaranteed as to timing or accuracy. But here's what I've done in addition to just listing those companies. I also have created we can customize the column set. So we have the symbol here. We're going to see its market capitalization, the last trading price, the yield, the dividend payout ratio, long-term debt versus capitalization, beta, and the ex-dividend date, right? So if you don't know how to do this, you can actually just click on that same customize gear that I did and then look them up. So here's what we're looking for. We can just look these up in alphabetical order or type in a keyword search. For example, if I wanted to find that dividend payout right there, dividend payout percentage of earnings, that's this right here. So I created that. I've shared that watch list. But then what I'm going to do now is we can detach this watch list, because right now it's just trying to fit. Let me open that back up. It's trying to fit in this little tiny 1.5 inch by 1.5 inch square, and we can't see all that data. But if we detach that, now we can see here are our dividend aristocrats. Here are the sectors those belong to, so we can look for diversification. Let's go through our list of priorities here. Diversification. Well, if the investor is looking to spread their investment out across a range of sectors, we can see those sectors here. Payment schedule. Right over here, I can see when dividends are paid. So this one pays in November, this one in December, that one in January, and that should continue on cycles going forward like that. Nice little navigational tip for making selections for these priorities. Consistency, well, they're dividend aristocrats, so we know that every single one of these has increased their dividend every year for the last 25 years. Debt, well, we have something known as long-term debt to capitalization. I don't know if you know what that is, but it measures basically long-term debt obligations taken on by the company against their access basically to cash through preferred stock, through common stock, through those sorts of things. In other words, long-term debt to capitalization is a measure of the net debt load compared to basically the size of the company. Now, it's not a perfect metric, but generally speaking, the dividend investor might look at this and say, well, possibly the lower the better. Now, across different sectors, there are going to be generally higher debt loads. So, for example, I might look at T. Rowe and I say, wow, their long-term debt is really low. But at the same time, we have I don't know, Hormel. Its long-term debt is about 9 times as much. Well, that's because one delivers a service and the other delivers a product, and which is going to require the spending of more capital to deliver that. Probably the product, right? So it is relative. But generally speaking, if we're comparing two otherwise similar potential dividend investments, the trader or the investor might lean toward the one with the lower debt load, because if debt represents a conflict of priorities and potential risk to the ongoing payment of the dividend, maybe they prefer that lower debt load. Now, another potential threat to dividend payments might be exposed through something known as the dividend payout ratio. So what I have displayed here, the dividend payout ratio, again, we're looking for just preserving that consistency as much as possible, avoiding threats to the ongoing dividend as much as possible. Let's go back here to this watch list. The dividend payout ratio is expressed as a percentage of the earnings over, you'll notice it says the LTM, the last 12 months. Sometimes you'll see this as TTM, trailing 12 months, but yeah, in this case, it's just the last 12 months. But so, for example, if I go back to, we were talking about T. Rowe, let's look at that. It has a dividend payout ratio of 55%. In other words, of its net earnings per share over the last 12 months, 55% of that was paid out in the form of dividends. Now, the higher that goes, that might be sustainable in the short term, but when we see very high levels of dividends being paid out relative to earnings or income, that may not be sustainable. Now, for these companies, they have managed to continue paying those dividends. So the investor might not panic because they see, let's say, a possible potential temporary spike in this payout ratio. Because here's a company that has not only paid their dividend, but increased it every year for the last 25 years. Sometimes these are just spikes. Maybe the earnings weren't quite as strong this year, but they continued paying their dividend. They might have had to do that from cash reserve. They might have had to do that by acquiring more debt. Both of those things are limited, so that's not something we want to see for very long. But in the selection process of one versus another, maybe a lower dividend payout ratio, maybe less long-term debt. And finally, we have our beta, which is just the volatility. volatility of that stock relative to the S&P 500 over a measurement generally of the last 5 years. That's our beta. So when we see a beta value, let's look at, let's say, how about Target? Target has a beta right close to 1. That means that it tends to move in the same direction at about the same rate of speed as the S&P 500. We would say it has a 1-to-1 relationship with the S&P. In other words, it's about as volatile as an average stock out there. When we have a lower beta, like SJM, it has a beta of 22. Lower volatility stock. CLX, also a lower volatility stock. So if an investor, maybe they're looking to get a high yield with lower debt, lower payouts of earnings as a ratio of earnings, and maybe they just want a smoother ride, they may emphasize that beta. But for each of these, we now have this little display here on this watch list that might help us see those very quickly and do a quick comparative analysis. So what I want to do now, we've covered quite a bit. I want to do a quick comparison of two stocks to sort of get the ball rolling in investing. We don't have any investments right now, so sector isn't going to be a huge point of emphasis. You might think, well, don't we look at sector rotation? It's kind of looking at things from a trader's perspective. Maybe we look at sector rotation to see, and we might do this, if the investor is looking to buy in a sector that's maybe fallen out of favor a little bit. Maybe that drives up the yield temporarily. That's a possibility. But for right now, how about let's look at T-Rowe. It has a beta, a little bit higher beta. This is a more volatile stock, so weigh this in your mind. A bit of a more volatile stock, not so much long-term debt, bit of a lower end payout ratio. Yield is just under 5%. And I have each of these are all actually prioritized according to their yield. So we have the highest yielding stock right up here and moving right on down to the lowest. So how about we look at this? And what I want is, let me get your input on, should we buy T-Rowe or should we buy something? Did we talk about Target? How about we compare that to Target? A little bit less volatile, a little bit more long-term debt, not surprising given the contrast in businesses here. Payout ratio is pretty similar, so relatively similar yields, different sectors clearly. What's one other factor that might play a role? Well, what about total performance? Here's what I'm talking about when I say total performance. Let's bring up a chart of T-Rowe, and I want to look at this over a long period of time. So here's how this is done over the last 10 years. And if we were to gauge how this has performed going from 10 years ago to today, it looks like up about 72%. I can see that right up there. See the percent change using this drawing tool as a measuring device? About 72, 73%. That's only what the price has done. All along the way, there have actually been dividends that have been paid, and those are not included in a price chart. They're subtracted from a price chart. If we want to show the combined total performance of price plus dividends paid, we can make a quick adjustment up here. Let's go up to our gear icon, go to equities, and I'm going to adjust for dividends. Right now, it's just it's adjusting the chart to show special dividends that have been paid, but I'm going to change that to all. So what that means is I want to show how this net performance of T-Rowe has been over the last 10 years, including price and including dividends. So watch what that does. As I click apply and click OK, my line is off. That's because, let me remove this drawing. If we look at price plus all those dividends, actually this investor has accomplished a return of 360% over that 10-year period. So that's a more true reflection of the value of this T. Rowe investment over that time. Now, as we look at this chart, you may also notice the behavior of price. During the period where where the bond yields were going up, a lot of these stocks struggled. Now been seeing those recovering though, as bond yields have been going down. There may be more investment interest in dividend stocks. It's not a guarantee. It's not a one-to-one relationship, and there's certainly other factors at play. But I thought that was interesting. So let's remove that and let's compare that longer-term total performance review to, let's say, Target. Now, this is just going to give a historical performance. It's not a guarantee of how things are going to go, but looks like about 186% for Target investors. But with prices down low, this may be representing stronger yields. When prices are high, those higher dividends, let's say, that $1 dividend may not be giving us as strong a yield as when they are low. All right. So what do we think? You've seen the fundamentals. You know that Target's in one sector and T. Rowe's in another. We've also even seen the longer term performance over time. Which company do you think we ought to start our investing with? Should we go with T. Rowe or should we go with Target? If it's helpful for you, I'll bring these back up here. If you want to look, there's T. Rowe paying dividends in December and each 3 months after that. Target pays in November and each 3 months after that. What do you think? Got to vote for Target. We got to vote for T. Rowe. First one to get 3 votes wins, and it looks like, okay, T. Rowe's the winner. So let's do it. Let's buy some shares. Now, here's what we're going to do. This is, we're going to be pursuing a sort of a diversification model here. So let's say that we're managing $200,000 of paper money. Let's, for our example today, spend 5% on our investment here. We're going to do that consistently, and we're going to be working to balance that around that range. So that means that we're going to be spending about $10,000 on each stock. $10,000, about 5% of our $200,000 portfolio. So I'm going to click on the ask price. That's going to bring up a purchase order for 100 shares. That's about $10,000. It's actually a little closer to 11. I'm okay with that. Let's just stick with 100 shares. I'm going to put this in as a market order and click confirm and send. So we are buying 100 shares of Target at the market price, and we're going to send that off. Obviously, when we submit a market order, we may not be thrilled with the price that we receive. It may be around 108.08. It might be less. It might be more. No commissions on this trade, but there can be on some types of trades. And we'll send that off and see if we can get that filled. There it is. So we bought those shares. They're down here. I'm going to move that to our dividend stocks group. I created this group before the webcast started, but just put in some custom columns here so that we can keep an eye on things over time. Ford was just an example stock. I'm just going to move that one out. Let's move that out to unallocated. That Ford just allowed me to create that group. All right, so there we go. We have started things off. We'll be keeping an eye on these, working toward working toward a diversification model over time. When might we sell these stocks? Well, if one of them grows to be disproportionately large, maybe 8% of the portfolio, we might cut that back. If one shrinks to representing less than 4% of the portfolio, we may add to that position. Those are just examples of rebalancing. But if any of our stocks stop growing their dividend, or if they get cut, let's say that our investor decides to pull a plug for those reasons. But guys, time to wrap it up. I'm going to let you go, but with a quick reminder that you do have a great slate of educational resources available to you from Schwab. Number one is, if you haven't subscribed to our Trader Talks channel, please do that. Trader Talks Schwab Coaching Webcasts is where you can join our live streams. You can find a playlist for previous webcasts, so you can just click on the subscribe button right down below. Now, also, you can follow Brent and me on X. You can find us on X at Brent Moore CS. You can find me on X at Cameron May CS. But if you reply to one of my posts here, I try to reply right back to you. You can finally follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. That'll take you to my profile. And if you reply here, I try to reply back to you as well. Allows for interaction in between these webcasts. But that was fun, wasn't it? We'll do this again next Thursday. I hope to see you then. Thanks, Brent, for helping out in chat. Thanks to everybody for the thumbs up, for the like. That's always appreciated. I will see you in a future webcast. I'll also look for you on X. But until that time arrives, I want to wish you the very best of luck and happy investing. Bye-bye.